The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks, and I started the show with a little bit of the esoteric. We're going to be looking at a tiny bit of astrology to start out with on this full moon day of July the 22nd. The moon was at perigee yesterday. In other words, it was as close to the Earth as it possibly gets, and that's why the moon always looks the brightest when it's at perigee. We also have maximum declination tomorrow, so there's a lot of things occurring lunar-wise that should at least be a temporary top in the stock market. But the one we're looking at right now is known as a grand trine. A trine is a triangle formation where you have the 120-degree angles within the triangle. 3 times 120, of course, is 360. And we have 3 of those with the major planets of Jupiter and Mars, Saturn, and Neptune. And so that's what we're watching here. This is such an important astrological event that my good friend Arch Crawford decided to get married on this day. Actually, they got married on Friday late at night because that's when Mercury came off of retrograde motion, and Mercury has gone direct now, so the communications thing should start working better for everyone. If you've been having trouble with computers or signing contracts, Mercury being direct is the best time to do those things if you believe in that classical astrology stuff. I don't study that stuff at all. As a matter of fact, this transit chart I would not see ordinarily, but Arch brought it to my attention because of its. He thinks it's important in the market, and basically the transits that I do, I use double planetary things. In other words, I'm looking between Venus and Uranus and what's happening between Jupiter and Neptune and those types of things. And when we do have some very strong patterns on this chart, and that's why it's called a grand trine, because you have 3 trines occurring at the same time among 5 different planets, and it's supposed to be, very, very important. And it's a very slow moving. The end of it actually ended on July the 17th, so it takes a little bit of time for this thing to actually kick in if it's going to, make the market turn down. That is going to be the $64 question. One thing that I did do over the weekend was that I looked at every chart in the Dow Jones Industrial Average. I went through every single one of them. And, of course, you know that the Dow Jones is price-weighted average, so that the price of IBM, trading well over almost 200, is a much greater weight than Bank of America, trading around $14. So the high-price stocks tend to be the leader of the Dow Jones Industrial Average, and that's why, it's not a very good indicator, because it should be capitalization weighted like we have with the New York Stock Exchange Index and also what we have with the S&P 500. Both of those are the ones that are better, better to look at. But I wanted to, the next chart that I wanted to post was the chart of the Bradley model, and I wanted to show you the fact that we've had a very interesting phenomenon here over the last 2 months from the high we made on the full moon back on May the 28th. Just give me a second, and I'll try to see if I can get the chart to come in. I'm having a little bit of technical difficulty here. I think it's okay now. I was trying to get a chart into Tiger TV, but if we look at the full moon that we made in May, which was made around the 24th. Then we came down to the full moon of the 23rd of June, and that was a very significant bottom because that was a Gartley buy pattern at that point, and then we went straight up until where we are now into a full moon. So we've had 1 complete cycle, actually 3 complete cycles from full moon to full moon to full moon, and one was a high, one was a low, and we're assuming that this one will be a high. Well, I have some additional statistics that I'm going to be sharing in the new book that's going to be coming out sometime around the first of the year that will show the statistics behind this. And again, we'll be looking at probabilities. There's no certainties at any time in the market, but this is what we're watching. If this one fails, this is going to be the first what we call a major failure in the Bradley model going back more years than I can count. In other words, it's usually not wrong for a total period, of 6 months, and it says that we should be coming down into the 6-month time frame, and that if it doesn't, that means it's going to be a failure. Any move above the Dow Jones, above 16,000, or the S&P 500 closing above 1710, would tell us that we would be looking at something that would be be very, very ominous. So that's what we're looking at with the Bradley model. That's what we're looking at with the Astro work. This is a full moon day, and so it could be up today a little bit, but it certainly can't be up tomorrow because it's not off by more than a day or so, when we're doing these. Now, an interesting phenomenon is when I went through all of these Dow charts that I was looking at, it was really quite amazing to see some of them because the one that looks very interesting is I put the hourly chart in on Microsoft, and that stock dropped well over 10% after earnings in just a matter of a few hours, giving you some really it went below the lows of last June. So I would assume if Microsoft gets back to that 33 level, that would most probably be an area where it's going to run in to some resistance at that particular time. Every single stock that I looked at in the Dow Jones Industrial Average, every single one has a bearish pattern. There's not one that has a bullish pattern that I could see. Not even one by any stretch of the imagination. Some of the larger ones that we're looking at, like IBM, and we will take a look at IBM here. It has a potential double top that we made way back in March, and then the high that we made in May was the full moon. Then we made a low on the full moon in January. In January 23rd, and then we have a full moon now. And this is we've been in a downtrend now in IBM since late March. So that's another one that is showing that. But I went through every single one of them. Microsoft, Bank of America, American Express, United Technology. I mean, every single stock that I looked at within that group of those 30 stocks was bearish. I mean, there's not one single pattern that I could see that would even be remotely correct of being on the bullish side. Now, I asked myself, are all 30 of these patterns going to fail? And I looked at the charts and I said, well, I don't think so, but we'll have to wait and see. If it does, that's going to tell me something. I'm not sure what it's going to tell me, but it's going to tell me something. So it's interesting to see how things are lining up with some of these things because it's really amazing. One of the biggest stocks in the Dow Jones, of course, is the Honeywell, and Honeywell has completed that 5-point reverse pattern that we've been looking at with the other markets. It went up and made a 1.618 expansion on Friday up at the 84.70 level. So all of these patterns, I mean, every single Dow stock is in a bearish mode based on pattern recognition, technical analysis that we look at. And of course, a lot of people don't believe in pattern recognition, but if you look at the numbers and look at the probabilities are such that not all 30 of these stocks are going to tell us that we're wrong here. Maybe, it's going to be different this time, and that's certainly possible, but I have not seen it this way very, very often. There's no question about it in my mind that we have something really big happening with these markets. And one of the stocks that I wanted to mention here was the stock of General Electric, because this was the one of the biggest bellwethers, with the Dow for many years. It was how goes GE is how goes the stock market. But, after GE made its low down around $5 or $6 back in 2009, coming down from $65 a share, it's only rallied back less than a third of its, former value. So this is in a big long-term downtrend, even though that it's completing this very bearish reverse point wave up here since June. So I can't be any more bearish than I am now. Unfortunately, the people at the stock exchange have not got the memo. I don't know what's holding them up so much, but we'll see. And there's always the chance, and it's a pretty good chance that maybe these will all fail this time, and it will continue to go higher. And there's a few warning shots across the bow here that are worthy of our attention. And the first one, of course, is the the VIX index is we've been watching this 135 pattern, and it's very dangerously close to failing. If the VIX index gets below 1210, that means it'll be going below the low point of 0.5 on the 135 pattern that we had more than a month ago, back in May, and that would tell us that the VIX index is no longer working. There's a great deal of support down around 11, but it is broken below where we thought it could go, and just because we think it's going to go there doesn't mean that it's going to go there. But these are things that we're watching as far as where things happen to be. I'm going to try to cover each of the indices today because they all look so very interesting all across the board. But the one that I wanted to mention on now is the E-mini S&P on the monthly chart, because that's a very interesting phenomenon, because if you look, when we made a new high in 07, we made a high by just a marginal new high, by just a very little bit. And this time what we've done is we've completed the 1, 2, 3, 4, 5 expanding wave pattern here in the S&P up at this 1690 level, and it's very, very close to what we think is going to want to be the most major sell signals that we've seen. Probably the biggest one I've seen since March of 2000. It's fact that with all the stocks that we're looking at, there's so many of them that are bearish. It's going to be hard to realize that we could come into a market that's going to go straight up from here. But in 1999, in January, we were looking for a top, not this type of top, because these patterns were forming on the major tops. In 99, you were looking at the dot-com bubble, a once-in-a-generation situation. That's totally different than what we have now. This is something much larger in time frame, as near as I can tell, because it's based on 15 years of charts going back, and that's a long time. That's a very, very negative patterns that we're seeing in all of these stocks. I mean, it doesn't make any difference which one you pick. They look good when you're looking at it from a moving average standpoint or a trend following standpoint, but if you're looking at it from a pattern recognition standpoint, it should scare you to death, because it's just literally a very, very negative situation in all the stocks that I'm seeing. And not just in the Dow Jones Industrial Average. It's just about everywhere of what we're seeing with the stocks. I mean, it's just one right after another. It doesn't make any difference. Google, who's been one of the the strongest, even with that, you've had a major pattern occurring there with the butterfly top, and Google dropped well over 5% in one day, and came back pretty good, but. Gotta tell me the break.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foresight Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. With over 3 decades of commodity trading experience, Andy Hecht has developed a system that combines both technicals and fundamentals. He calls this approach Technomental, and now you can put it to work for yourself with his brand new service, the Technomental Commodity Report. In this weekly newsletter, which comes out each Thursday morning, Andy gives you his analysis of the market price direction bias using fundamentals, and then specific trade recommendations including entry and exit points using technicals. The recommendations in the newsletter are always based on stocks and ETFs, so a futures account is not required, and Andy will often use options in the recommendations as well. Andy will tell you where to get in, where to get out, and he'll outline the risk-reward profile for all recommendations. To get your month-long free trial to the Technomental Commodity Report by Andy Hecht while locking in the low introductory rate, visit the front page of TFNN.com today.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, the next chart that we have going in the Tiger TV is the long-term weekly chart on crude oil. And as you can see, we've had 3 lower tops here. Since 2011, we hit the 11.14 a barrel back in 2011. In 2012, we hit 112 a barrel, and so far we've been to $109 a barrel. This is going to be very interesting here at $109 a barrel because we have several targets and patterns that end up around the 109 level. It's selling off a little bit today, but it's still too early to determine whether this is going to be, something of a major move. We are having, in the gasoline futures, it is even more bearish, and also in heating oil, all 3 of those are all part of the crude oil component, and both the heating oil and the natural gas are far weaker than we have in the crude oil. So we are expecting a move down here in oil. The question is how much it's going to last and how long it's going to last and how much it's going to be if we are in fact correct. But we do have one that we've been very bullish on for quite some time, and that is the gold market. It is held up above that 1170 level on the long-term weekly charts in the market in the gold, and it has held up extremely well. And what we'll be looking at now in gold is a pretty significant breakout. I wanted to show the difference between the gold and silver because silver had been lagging badly here on the gold and silver, but as of last night, once we cleared the $20 per ounce level in the silver, we took off and went, a great deal higher, which was something we were expecting to have happen because the gold had looked bullish. We've been making these higher bottoms in gold all along now since the last, it's been, I can't remember the exact particular time, but we've just absolutely, when you see this chart, we've had an uptrend for quite some time, and then we went sideways for 8 days, and that's when we really broke out, was last night. And folks, let me explain to you what happened last night, because it's worth the price of admission. I'm going to switch and do something that I don't do very often, and that is to put a 5-minute chart up on the gold market, because you have to see what actually occurred to believe it, because I'm going to highlight the area so that you'll get an idea of what happened. But when gold opened, it opened about $1 higher last night, and then in a matter of 5 minutes, it moved almost $20 an ounce with virtually no volume. I was watching the bid and offers, and they were all 5 lots, 2 lots, 3 lots, 10 lots, 20 lots. There was nothing huge in there at all. And then after it got to the $1,315 per ounce level, it went sideways for quite a while before jumping up above the $1,325 level. Now what we've done is we've exceeded the 786 of the last move that we had that occurred way back in June. And so this is telling us that gold is finally starting to move. And as you recall, we've been watching the gold on that long-term chart that showed us where the 61% retracement was on the weekly chart. And now it's beginning to look like, the thing that we've been possibly looking at is starting to unfold, and that we've had this really strong rally, because now we're up more than $160 off of the bottom in just the last 3 weeks, 3.5 weeks alone. So we are starting to move higher. How far this goes, we're not sure, but we've already exceeded 786 of the last down move, which tells us that we're most assuredly, well, there's no such a word as assuredly in our business, but there's a high probability that we're going to at least to get above the 1452 level. And, when we were down there, the whole world did not want to look at gold, but that's when everybody was the most bearish, and that was back on the 17th or 18th, around the 28th of June, as I recall, is when the real bottom came in on the gold. And here we are next week. Next Sunday we got the 28th of July. So it's been a month, and we've been very strong up move. But the breakout today, what you would want to be watching for is to buy the first ABCD correction. The Thunderbolt pattern that we like so well, is to look to buy that one, because that will be the one that looks to be the most productive. H.M. Gartley, in his book Profits in the Stock Market, said one of the better trades is after a market has turned bullish, buy the first ABCD correction. And if the market is bearish, sell the first ABCD correction. Okay, we're going to take a little break, and we'll be back after this to cover the bond market.
With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter, Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position, for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I wanted to post the chart for the Russell 2000 into the Tiger TV to show the ABCD pattern that's completing. We also have a 3-drive pattern that is completing, and that's a very small index, but it does have some pretty good people following it. We also have the New York Stock Exchange Index, and as you can see, that we have not made a double top yet. We've made a expansion in the Dow Jones Industrial Average. We went above 1.27 of the May high. We did this also in the NASDAQ. We are not quite there yet in the S&P, but if we should get above 1,700 in the S&P futures, that would tell us that we would make a 1.27. So all of these are completing at the same time that we're looking at some pretty heavy astrological things. The whole world is bullish. There's no question about it. If you try to tell people, to get out of your stocks here, it's just as hard to try to get them to buy it when it was in March of 2009. It was impossible to get anybody to buy anything at that time. Believe me, it was. I can remember quite vividly of some of the things that were occurring at that time. I wanted to just to show you folks what's happening in the gold market, because we've had a really strong resistance area around that 1,300 in the gold, and we shattered through that today, and we've gone up to the 61% retracement and almost at the 1.618 expansion at 1335. So the first correction that we get in gold, where we get a first good ABCD correction, much like we had, if you remember back on July 4th when the gold was down around 1216, we had our first Gartley pattern. That was the ABCD pattern that we talked about, that Gartley said buy the first ABCD pattern after a bull market had started, and we assumed that the bottom was going to hold at $1,170 an ounce, and it did, and it made the 61% retracement at $12.12 per ounce, and now we've completed, this pattern to the upside, and we're breaking out above the 50% level. It's taken a month to do it, almost exactly a month, but it's on its way now. Doesn't mean it's going to continue from here, but at least it's got the attention of some people that it does have some life left in it after all, after so many people were bearish back on June the 27th. Most of that is changing now, and that's what you're looking for. It's particularly when we have silver finally, coming to the party and being a little bit stronger, than we were before. And I think that part in itself is very, very important. Now, the next one that I want to switch over to the bond market here, because I wanted to alert you to something that I see happening, and that is that these high yield or junk bonds have started to rally again. In other words, people are clamoring for yield. They're not concerned about the safety behind anything. They want the return on yield. And since Treasury bonds have been hit quite a bit, the yield on the junk bonds is much higher. In fact, the spread between the junk bonds and the 30-year, AAA or supposedly AAA government bonds has widened out quite a bit. Now, the reason for that is they're clamoring for yield. They're not concerned on the return of their money. They're concerned the return on their money. And that's the wrong thing. You want to be concerned of your capital. Don't worry about how much you're going to make, because people are going to give you, a line of baloney about what you're going to make. It's how much you can get back, and that's the real key to looking at that. I know there was a muni bond scandal over the weekend where the Detroit has filed bankruptcy. That was probably a biggest surprise, is that Santa Claus is going to come on Christmas Eve, because that city's been in trouble for a very long time, and this last thing was just the hammer that to put the nail into what they're doing. And probably this would be the time to be buying things in Detroit, because things are so bad there. But it was once a great city, and it is under demise because of things like over-leveraging their debt, offering too many services that they couldn't afford. Oh, sounds like I'm talking about the U.S. government. But that's where you've got to be careful, is because if you give too much stuff away, somebody's got to pay for this, and that's where the problem lies. I couldn't believe where it said that 50% of the people in Detroit were delinquent on their taxes. Boy, I tell you, if in Arizona, if that happens within 60 days, they abscond with the property and sell it to somebody else. That's for sure. Now, I want to show you the Treasury note market, because we had a big break in those notes during May to June, end of July, 1st of July. The actual high occurred on the full moon in May, which was on the 28th. Then we broke down and we bottomed on July the 5th. And so far, we've had just a very, very minor rally, just a matter of a few points, a couple points. We'd like to see it get back to maybe a few more points higher in the notes, around 270. That means the yield on the 10-year note would get, right now it's running at about 3.1. To get it back to around 2.9, that would be the place where I would be looking to sell notes. Folks, it looks like these interest rates have turned down. Sorry. The notes and bonds have turned down. Interest rates have turned higher. We've been looking for higher rates for some time now, and we certainly are getting higher rates all across the board. There's no question about what's happening. Currently, what we have going on in the Treasury bonds is where we are right now is that we're making a 786 retracement from the highs we made on July the 3rd when Bernanke gave his speech, and that sent the bonds tumbling down 5 points, 4.5 points down to the other area. I had a request to discuss the the chart on Honeywell because that was one of the charts that I looked at in the Dow Jones, and I'll be happy to put that in there to let you folks look at it. This is from Joe in the Tigers chat room. Basically, what I'm looking at here, Joe, is the 1, 2, 3, 4, 5 expanding triangle. Basically, your wave 2 must be exceeded by wave 3. Wave 4 must exceed wave 2. And then finally, you go up and make an expansion to wave 5, which will either be a 1.27 or a 1.618. And with the strength of this market going up, it appears that the 1.618 is the number to look at. So it basically tells us that we should not get much above 85.5 on Honeywell. That would be the game plan that I would be using if I were watching this stock. But it is certainly a completed pattern. It looks just like the other stocks that we've seen that have had these huge breaks from this level. So if you sell it somewhere around the 85 level, your risk would be roughly 2%, and 2% of $85 would be roughly $1.70. So you'd put $1.70 to stop on that short. I don't like the puts because they're already fairly priced because somebody's putting in a big premium. Even if the market should drop, you wouldn't be able to make any money because of the time delay that you have and the cost of your premium. That's one of the disadvantages of trading options. If you ever go down to the Chicago Board Options Exchange there on Jackson Street in Chicago and go into the first floor there, if you go into the gallery and watch the traders down on the floor, and there's still a pit there. Well, it's a floor. It's not a trading pit because they have the people walking around making markets all the time. But you'll see the people in the pits that are wearing the exchange jackets. They have little badges, and it basically says, sell a Mercedes and buy an option. No, I get that wrong. It says, sell an option, buy a Mercedes. So if you're selling an option, you're getting the premium, and 90% of these premiums are never cashed out, so it's just money in the bank. The problem is it's that 10% of the time, when you're totally wrong. Like, if someone would have bought Apple calls, when Apple was around $685 or $690, thinking it was going to go to $1,000, and he paid a very heavy price for a put or for the call itself, and yet it expired worthless. So the person that took the other side of that trade claimed the whole option. So when you sell an option, you're going to get the premium, and you're going to be right about 9 out of 10 times. But it's that 10th time that if you don't act, you're going to be hurt badly. There's a rule of thumb when you're trading options or selling options, like that's what a professional would do. He would sell the calls and just pocket the money. But if you sell a call and the call doubles in price against you, the rule of thumb is get out. So if you sell a call for $10 and it goes to $20 because the price of the stock is going up, you just exit the trade and go to the next one because they'll be right 9 out of 10 times. If you go look at the statistics behind the CBOE options, 90% of the time the options expire worthless, but 10% of the time, and that's where the problem lies, that things go crazy, and that's where it's very difficult to get out of some of these things. For instance, if you were in gold today with a put, and you had sold a put that gold wasn't going to get above 13.10, all of a sudden you've got gold trading at 13.32. So that thing is now underwater big time. And if you didn't protect yourself, you were left to the the whims of the market, and that's not where you want to be standing. But anyway, the Honeywell does have a reverse point wave there, and it is extremely bearish pattern. I want to get back to the bonds here for just a second because we have a situation where we're back up testing the 786 level at that 35.25 area in the Treasury bonds. We took out the highs of the 17th of July right at this level, so it appears to me that we're getting ready for another leg down in the bonds. But if we close above the 136.10 level, not very far away, about 20 pips from where we are right now, that would tell us that this market is probably getting ready to rally a little bit more. Ideally, we'd like to see the bonds rally up to the 139 level over a 10-day period. We're 10 days into it now, so if we go a few more days of rally before we start to turn down, it would be a big place to take a look at the short side of the Treasury bonds. But I don't do recommendations on puts and calls. In fact, I don't even like to trade the ETFs. I think the ETFs are not what they appear to be. So because I don't know much about those things, I'll leave that to the professionals in the market, and let them understand what it's looking at. The next one that I wanted to cover in the Dow Jones is the chart of 3M, one of the best companies in the Dow Jones. They've been in business for over 100 years and have some of the best products out there. Most all of us use, of course, one of their famous, which is Post-its, and, of course, many other things, all the different types of tape that they come out with and memory things. It's just amazing. This company is, completely diversified. But here again, we're seeing that same 1, 2, 3, 4, 5 expanding triangle completing up at the 115 level in 3M, and that's what we are looking at as far as a very significant sell signal. At least get out of Dodge type, get out of your longs at that level, because that's where you'd really be looking at a chance for a really significant retracement. A minimum retracement of well over 20% was what I would be looking for, if that. The earnings come out, I guess, on Thursday, and we'll see if that's going to have any effect. Well, they will, but whether they have the effect that we think, we don't know. We can see what happened with Google, and we can see what happened with Microsoft. Was the fact that we had very, not very good earnings at all, and that caused for both stocks to sell off quite a bit. Okay, I had another question from someone in the Tiger TV family, and that was about the long-term position on Treasury bonds. Well, folks, about 18 months ago, we were talking about the Treasury bonds, completing this major butterfly pattern that we had occurring, from a long period back, going back to 1981. That's when interest rates started to come down. That's when bonds started to go up and interest rates started to come down. And now we've completed the big butterfly that was up here that completed about a little more than a year ago. And now what we're doing is we're starting to back off. Now, we have taken out the interest rates of the previous year. In other words, our rates are now higher than they were last year at this time. Mortgage rates are substantially above 4% for the 30-year mortgages right now. The 15-year wraparounds are still below 4, but not by much. And your 10 years are still below 4, but again, not by very much. They're like a 3.89 or something like that. So all of them are coming together at a time where things are telling us that we are at a real critical thing in nature. Now, the next thing that I wanted to cover is I want to cover money, because money is the thing that makes all this stuff work. And I think the best way to do that would be to take a look at the dollar index. And if you get a chance to go into Tiger TV, this is an interesting chart going back the last several months. It responds pretty nicely to the full moons. The full moons and new moons are very instrumental at calling the highs. We've got to take a break here. We'll come back. We'll finish up the show with the U.S. dollar index.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I'm going to end the show here with the U.S. dollar futures chart. It shows that same 1, 2, 3, 4, 5 expanding triangle pattern. Gartley referred to it as a T6 pattern in his book. And basically what it means is it's a 3-drive pattern also, because drive 3 is higher than drive 1. Drive 5 is higher than drive 3. But what makes this such an interesting pattern is that wave 2 exceeds wave 1, and then wave 4 exceeds wave 2, and that's why the triangle is expanding higher. What's interesting about the chart that we see now is that we are at a 61% retracement on the dollar index at this particular point. And if you'll notice, that's almost exactly where we were when we were at swing 2. So what we have is a head and shoulders pattern. You have the left shoulder at point 2, and you have the right shoulder completing right now, with the head being at swing number 4. And so we have a head and shoulders pattern forming in the dollar index at the 82 level. We're now trading at 82.26. Now, if you're not interested in the dollar index, you could look at the euro, because the euro has major resistance, in other words, 61% resistance at the 132.60 level. So we're about 60 pips away in that for the euro, but the British pound has made it exactly up at the 153.80 level, so that is completed. We already we've talked about the Japanese yen. That thing is still being weak to the dollar, which is what we would expect. So the dollar index is telling us, as long as we can stay above this 82 level, that we've got a chance for the dollar index, to return to its bullish posture. Not pasture. I'm the one that's in the pasture. This is the posture. Anyway, the difference between wave 3 and 4 in the dollar index is right now where we stand. We're at 61% of that from where we stand at wave 5. That's at 82 in the U.S. dollar index. So it's very, very important to watch. It's a head and shoulders pattern. We're over some major timing things, cycle-wise. At least we believe we are, and that's that's what the bottom line is poised to do. This will be a big week, I think. In fact, is when you look at the non-volatility in the stock market, it's very, very scary. It's just so complacent out there that it's really amazing. We haven't had any corrections in anything. We finally started to see the NASDAQ have a pretty substantial correction this morning. The rest of the market couldn't follow through, of course, but the NASDAQ, was certainly holding its own all the way along, and then it's broken badly. And I will put that in there. You'll see that over the last period of time that the NASDAQ, broke well over 30 NASDAQ points. That was 50 NASDAQ points, and we've gotten back just a very little bit of that. So that could be an indication that the market is getting ready for a substantial correction. If I'm correct, and that's a huge if, this could be the correction that is going to change a lot of people's lives. I've never seen so much bearish stuff out there, folks. I know I probably ought to stop and get a day job and do something else, but I'm just frothing at the bit to get in some of these markets, and they really look very, very bearish. And I just can't believe that all these patterns are going to fail. I mean, it's just so many of them all across the globe. And when you look at China and Hong Kong still in downtrends, and almost all of South America. Anyway, we've got to take a break here till Wednesday. Live every day in an attitude of gratitude, and may God bless.
Nowhere, spelled N-O-W-H-E-R-E. At one point, we've all been there, whether it be our health, career, or our finances. Some might be there right now. So where are you when it comes to your trading and investing? Better yet, where would you like to be? The good news, I can take you from nowhere to now here right now. Same letters, N-O-W-H-E-R-E, just a totally different emphasis and focus. Hi, I'm Steve Rhodes with TFNN, and on July 25th at 6:30 p.m., I'm going to share with you a trading strategy that I began on May 10th when the S&P was at 1627 and closed at the same price 8 weeks later. That's right, the S&P went nowhere versus a trading strategy that produced a 100% hypothetical return in that same period of time, and it's now here for you. Subscribers to my daily newsletter service, Mastering Probability, have free access to this exciting live workshop. The trend is your friend. All the details are on the homepage of TFNN.com. Decisions shape your destiny, and your trading destiny is now here for you.